Understanding technical analysis can mean the difference between buying here or here. And for a large percentage of traders, technical analysis is the very basis of all of their decision making in the market. So I decided to put together an ultimate beginner's guide highlighting all of the must-have information to save you a ton of time trying to figure it all out on your own. So first and foremost, what is technical analysis? Simply put, it's a method for analyzing and forecasting the direction of price through the study of market data, primarily focusing on price action. And price action is just simply the movement of price for a financial instrument over time that's plotted on a chart. And since we're discussing terminology, let's continue with some of the main terms that you need to know for technical analysis. Let's start with the movement of every market. Price can do only three things. It can go up, it can go down, or it can go sideways. So when price is moving down or in a selling market, we call this bearish. And on the flip side, when price is buying or going up, we refer to this as bullish. When someone is looking to sell in a bearish market, this is referred to as a short position, and vice versa when buying in a bullish market, which would be a long position. The third movement, which is price moving sideways, we refer to this as consolidation. Consolidation is a period of range-bound price action after an extended move. This just illustrates the lack of a trend in a particular trading range. Think of it like price taking a break before the next move. Now, once price starts pushing aggressively out of a range or consolidation, this is characterized as a breakout. The market will always expand or contract. It's like the heartbeat of the market, and breakouts will lead to one of three things: a trend continuation move, a reversal, or manipulation. So when a trader can observe a series of strong impulsive moves all in the same direction, we can identify either a bearish or bullish trending market. These impulsive continuation moves are referred to as expansions, and a trend is just simply a tendency for price to move in a particular direction, and it can be short or long term depending on the period of time that is selected. All trending markets are essentially made up of two key components. We have expansions and we have pullbacks. Consolidation can be found within a trending market, but typically it'll emerge in the overextended points after an up or down trend. An easy way to determine a bullish trending market is by identifying a series of higher highs and higher lows during a specified period of time. Higher highs refer to an upward trend in which the price of an asset creates a new high that is higher than the previous high. Higher lows refer to an upward trend in which the price creates a new low that is higher than the previous low. In a bearish trending market, it is just the opposite: lower highs and lower lows. So a lower high occurs when the price of an asset reaches a high that is lower than the previous high, followed by a downward price movement. A lower low occurs when price of a currency pair reaches a low that is lower than the previous low, and then followed by a downward price movement. Pullbacks or retracements refer to the price action between a high or a low and a higher high or a lower high. These highs and lows are also called swing points or swing highs or swing lows, which are the framework or structure that any given market is currently trending. So I know that sounds like a whole lot of gibberish, but it'll all pull together. The break of structure is the first clue that the market is potentially getting weaker or that it's about to reverse directions. And you can identify a break of structure in a bullish environment when price exceeds and closes below a previous higher low, or in a bearish environment when price exceeds and closes above a lower high. This would be classed as a break of structure. Now, in addition to consolidation and trending markets, the highs and lows of price action can also create what we call support, resistance, and trend lines. And since we just discussed a trending market, a trend line helps technical analysts to determine a trending market by drawing diagonal lines over pivot highs or under pivot lows to show the prevailing direction of price. Supports are areas on price charts that price is less likely to drop below, and resistance represents areas in the market where price is less likely to break above. Think of support like a floor, resistance like a ceiling, and trend lines like a staircase for price. And these three things are significant because they're the foundation for almost every single trading strategy, because they help a trader identify key areas in the market that can be used as potential opportunities for an entry. There are many terms and abbreviations when it comes to technical analysis, but I don't want to overwhelm you. What I've outlined for you will provide a solid foundation for you to start with. And I know a lot of this may sound confusing if you're new to trading, but don't get discouraged. Market structure is one of the hardest things to read and understand when it comes to trading. It's essentially like learning a new language, and it's going to take time and experience to fully grasp. So now that we have discussed the bones of the market, let's get you set up. And it's super simple. The first thing you'll need to do is select your trading platform. The most popular platform by far for technical analysis, and what I recommend you use, is called TradingView. This is a web-based platform as well as an app for your phone, and there are free versions that you can start using right away. This is the platform that you're going to use to select or search for a pair or an asset that you want to analyze. And then it's going to display a price graph that you can then draw on and apply whatever strategy you're using to identify trading opportunities. The first indicator we're going to talk about is the candlestick graph. Now, this is one of the most popular ways of looking at how price changes, and at first it can look overwhelming because we have the ability to view candles at different time frames. You can view candles per second, per minute, per hour, per day, per week, and even per month. The time frame a trader views price action has a lot to do with the style of trader they are. For example, you have scalpers, intraday traders, swing traders, and position traders. Scalpers and intraday traders are in and out of their positions relatively fast, so they typically view the market on lower time frames. Swing and position traders, they're holding their positions for hours, days, sometimes weeks, or even months. Therefore, they're viewing price and doing their technical analysis on higher time frames. The higher time frame views will always hold the most weight and provide the clearest picture of what price has been doing and will most likely continue doing, because it's viewing price action on a bigger and longer scale. As you start dropping time frames, let's say a monthly to a weekly time frame, now you're viewing two sets of data that you need to analyze individually and collectively. So you can see the lower you go in time frames, the more data you're analyzing and combining, which can get extremely overwhelming and confusing for inexperienced traders. I would really recommend sticking to higher time frames at first until you get some experience, and then you can go from there. This process of analyzing price action from higher time frames down to the lower time frames is referred to as a top-down analysis. This is an extremely good practice for traders to perform so that you have an accurate forecast of what price is doing. So circling back to the candle charts, let's look at the colors first. On TradingView, you can customize these and change the colors, but a standard default chart out of the box settings will present green and red candles. Now, if we're looking at a daily time frame, a red candle tells us that for this specific day, price was bearish, or that an asset closed at a loss. And a green candle tells us that price went up. But we can dissect these candles even further by looking at the opening and closing price. If the candle is red, then the closing price is the bottom end of the candle body and the opening price at the top. And for a green bullish candle, it's the opposite. The bottom of a candle body is the opening price and the top of the candle body is the close price. The second part to candles are the wicks, and these are the little thin vertical lines that you'll see on the tops and bottoms of some candles. These represent the highest and lowest price points points for that day or whatever time frame interval that you're viewing. These wicks come in a variety of sizes, and sometimes you just see them on the top or the bottom of candles, which can indicate strong bearish or bullish momentum. There are different ways that you can use candles for technical analysis, meaning that traders can look for patterns with individual candles like a dragonfly doji, which is a candlestick pattern that can signal a potential reversal in price. Another way is by combining 2 or 3 candles, like an engulfing candlestick pattern, which uses 2 candles that form when a small candle is followed by a large candlestick and the body overlaps or engulfs the body of the previous candlestick. A popular 3 candle pattern would be an evening star, which is a candlestick pattern used to predict bearish reversals. The other way traders use candles is by looking at formations they create, like a flag pattern or a head and shoulders pattern. Most strategies use a combination of candlestick patterns and formations that align with support, resistance, and trend lines. There are countless strategies out there that you can learn, but they are all rooted in 2 popular but very different concepts. The first, which I use, is referred to as smart money concepts. Simply put, smart money concepts are rooted in the idea of understanding how price moves with manipulation, algorithms, and identifying the footprints left behind big money players. The other is referred to as retail concepts, which is your traditional support, resistance, and trend lines that are usually paired with indicators such as RSI or moving averages. This will ultimately come down to testing things out and seeing what works best for you. Technical analysis strategies all do the same thing by telling you when and where to enter and exit a trade based on current and historical price action. But regardless of which route you take, remember this: the trend will always be your friend. Another commonality between the 2 methods of technical analysis is the use of indicators, but retail concepts primarily use price-based indicators, while smart money concepts focus more on time-based indicators. Trading indicators are mathematical calculations that are plotted on a price chart that will aid a trader in identifying certain signs and trends in the market. They are simply a set of tools applied to a trader's chart to assist the trader in making a clear analysis. I personally don't use price-related indicators, as I use a naked chart and I just focus on price action itself. The indicators that I personally use are time-based, which help me plot market session open and close times, previous week price action, and annotate previous day and previous week highs and lows. Just be careful with indicators because there are thousands of them and it's an easy rabbit hole to fall into and get lost in. And I can also confidently say that no indicator can compare to learning pure price action itself, because most indicators are lagging, which means they will paint on a chart after price moves, and they can also repaint. So depending on what strategy you choose to learn and from who will most likely determine which indicators you should use, if any. On the other side of technical analysis is fundamental analysis. These 2 approaches are on the opposite end of the spectrum. Both methods are used for researching and forecasting price movements, but fundamental analysis is a method of evaluating securities by analyzing a business's financial statements and its health. It can also consider the overall state of the economy and factors including interest rates, earnings, and unemployment. Technical analysts typically accept 3 general assumptions. The first is that the market discounts everything. This is referencing a trending market where price, after making a high or a low, will pull back to a discounted area before continuing offering opportunity. The second is they expect that price, even in random market movements, will exhibit trends regardless of the time frame being analyzed. Third, they believe that history tends to repeat itself. This repetitive nature of price movement is often attributed to the market psychology, which tends to be very predictable based on human emotion. emotions like fear or greed. And as a Forex day trader, although I do pay attention to time-based macroeconomic news events, primarily for times that I can expect volatility, fundamental analysis plays no part in my decision making. From my experience, fundamental analysis plays a bigger role in stocks and crypto investing. My goal with this video isn't to teach you how to trade, because I have a ton of videos that teach my strategy. My goal is to provide beginner traders with the framework of technical analysis to start off on the right foot and help navigate through all the noise in this space. There you have it, some of the useful tools and information that you can use to get started in your own technical analysis journey. This video was just scratching the surface, but you should have a pretty good idea of the road that lays ahead of you. Now, if you want to check out more of my educational content, feel free to check out the description of this video and some of my other beginner guides on my YouTube channel. Make sure to like and subscribe, and I'll see you in the next one.